Welcome to Module 5, Section 1, where I will talk about market analysis. One of the things that we have to be aware of is what is the context of the market at any given time. It probably would not surprise you that a lot of market participants don't really know the context. They get into an investment and then it goes against them and they wonder why. Well, did you understand the context? Now, there will be trades or investments that we get into where we do get in at 10, get out at 15, only to see the stock climb to 20. But that is according to a plan that we have. That was our target when we entered into the position. Once we get in, we ride it, it hits our target point, and then we get out. We don't really worry about woulda, coulda, shoulda after that. To help make good decisions, we need to understand, are we in an uptrend? Are we in a downtrend? Are we going sideways? We need to have a good understanding of the market climate. There's a real delicate balance between using logic to base your decisions on current conditions versus just following what everybody else is doing. And you might be surprised to know that people are just like cattle, and if all the cows are going in one direction, other cows want to go in that same direction. They follow the herd. If it becomes the trend, the fad, the cool thing to do, it doesn't necessarily mean they're making good decisions. They're just following what everybody else is doing. As I record this, the real rage these days is to deal in cryptocurrencies. Everybody wants to get into Bitcoin or Doge or Ethereum or a lot of the other cryptocurrencies that are out there. A lot of these people don't really understand what they're doing. They just see an opportunity to get in, try to make some money, and then get out. That's all they care about. They may be looking to buy when we're in a strong downtrend, or they may decide to sell when we're in the midst of a big uptrend. They don't really understand what is happening. Somebody else is telling them what to do, and so they're just acting upon that. What I try to really focus on in my program is, okay, we listen to other people. We might pay attention to what they say, but ultimately it comes down to us making a decision for ourselves based on current conditions and how we've learned to interpret those conditions. We try to reach conclusions that are objective, not subjective, where you're putting your own opinions and your own beliefs and your own desires into the market. No, we want to look at unemotional data, then interpret that data in an unemotional, unbiased way, and then reach an objective conclusion. And this gives us, over the long haul, the greatest chance for success. The problem with using subjective conclusions is you'll be right just enough times to justify that you're doing things the right way. The market has its own way of doing things, and it doesn't matter what your feelings are. It doesn't matter that you want the market to go up or you want it to go down. The market is going to do what it's going to do, and so we need to look at information that will tell us what the market's going to do, not necessarily what we think the market will do. So when we look at market analysis, we use tools to help us reach objective conclusions. We use these for analysis, and we can break these tools down into three main categories, and these categories will be covered in their own sections later on in this course. The first one is fundamental analysis, and a lot of the fundamental analysis that we rely on is mainly around the news. What is happening in the US? What is happening globally? What is happening on Wall Street? What is happening in Washington, D.C.? We didn't used to have to really pay attention to those things before. We live in a very politicized environment now where things that happen in Washington, D.C. not only affect our lives, they also can influence the stock market and sometimes defy logic. So different events that go on in the US as well as across the globe can have an impact on the S&P 500 as well as individual stocks. Even if you don't invest in indexes, the videos that I make will still be very useful to you because I'll give you a more big picture view of what's going on, and a lot of times that will filter down into individual stocks. The second tool that I will talk about briefly here, and I have a section that I'll talk about this more in depth, I rely heavily on technical analysis, and I teach a really extended class. It's not one of the free classes, but I do have an in-depth class on technical analysis. What we do when we use technical analysis is we study charts and indicators. Charts are just price movement. going up, going down. There's a lot of different kinds of charts that we can look at. And then indicators are mathematical calculations that are based on price or based on volume or based on both. And we can look at these different calculations, and quite often they will give us insight as to where we're at right now and where we're likely to be in the future. This is probably what I spend most of my time doing. I look at charts. I look at hundreds of charts every day just on the S&P 500. But then I'm looking at other markets too, because what happens in the bond market, what happens in gold, what happens in oil, what happens somewhat in cryptos may have a bit of an influence on the stock market. And we call that intermarket analysis. And I have another section where I talk more in depth about that. And in some of my other classes, I go into a lot more detail. The third area is probably the most important of all. This is mental analysis. This is getting a hold of your emotions, dealing with fear and greed. You might be an expert at fundamental analysis or technical analysis, but if you can't get a hold of your own emotions, number one and number two don't even matter because you're doing everything on an emotional basis. It's like all logic is flying right out the window. So we need to get to the point where we approach the markets with maturity. We understand that fear and greed exist. We understand that there'll be times when we're right and we'll be happy about that. There'll be other times when we're wrong and we'll be unhappy about that. But we still have to move ahead anyway in an unemotional fashion. And we have to try to conquer those things as much as possible. So the mental process can involve all the different phases of a trade or an investment. It can be when you enter, just getting up the courage to place that order and to actually get in at a time that you've determined this would be a good time to enter. And then while you're maintaining that position, what kind of emotions are you going to go through? You might get in at 10 and it goes to 12 and you're really happy about that and you have your stop loss order set. But then it starts to drop back down. What are you going to do emotionally during that time? Are you going to stick to your plan or are you just going to make up a plan as you go along? Then if we get to 15, well, that was your target, but you notice that your stock is still in a really strong uptrend. So you might modify your plan when the market's closed and say, okay, we hit my target of 15, but things are still looking really good. Maybe I'm willing to raise my stop losses and hold on to this investment for a little bit longer because things are more positive than I thought they would be. And then what kind of emotions are we going to deal with when it gets time to exit a position? Did you set that up as part of your initial plan? It could be weeks, months, or even years down the road before your whole plan is carried out. And so you have all of the emotions that go along with that. Let's say you get in at 10 and the stock goes to 30, you're looking pretty good, and then all of a sudden it drops back and you decide right then and there to get out. That wasn't part of your plan. You just decided, okay, I've held on to this long enough. I'm happy with the profit that I have. I'm just going to get out right now. You're really just making that up as you go. And then what's really frustrating is after you get out, you see it shoot to 40. One of the things that we can look at for market analysis is we start with the biggest picture possible, and then we get smaller and smaller and smaller until we get to the position that we're interested in. If we're trading an index, we get to that index. And then we might go a little bit beyond that by looking at sectors and industry groups, where if you're dealing with individual stocks, you look at the index and then you drill down a little bit more to look at strong sectors. And then within those sectors, you drill down even more to look at industry groups. And then inside that industry group, you look for a stock that is appealing to you. The charts that I'm going to show you here are two different types of charts. They all go back to 1980. So we're getting a nice long 41-year history of prices. The first type of chart that we're going to look at is called a logarithmic chart, or we just call it a log chart or a log price chart. A lot of the software packages that you use, including stockcharts.com, which is the site that I use to get my charts, if you plug in a symbol, it will automatically come up as a log chart by default. Well, that's good, and those are helpful. But there's other kinds of charts that we can also look at. When you're looking at a log chart, the prices that you see are based on percentage movement. And this is often the default setting. And I'll show some examples of these charts coming up here in just a minute. So it may look a little skewed to you. Then we also have what are called linear charts. This is also called arithmetic or if you want to say it in a fancy way, arithmetic charts. I've heard it pronounced that way before as well. But these are just prices that are equally spaced and they show absolute values. And I'll have some examples. So which one is best? I like them both. They both have their place. We get a little bit different view of the same information, and sometimes that gives us additional insight that we didn't have before. Also, the charts that I'm going to show you are using different time frames, both log charts and arithmetic scaling. The first chart that we'll look at is a daily chart. It's not a bar chart. I'm just using line charts here, where each plot on the chart is 1 day. And then in addition to that chart, I have a 200 simple moving average. There's roughly 200 trading days each year. The 200 moving average is the most popular moving average. And so I use that since millions of other investors also use that. We're all looking at the same thing at the same time. And I use a simple moving average where day number 1 and day 200 have equal weight. A variation on a moving average would be an exponential moving average, where day 1 doesn't have as much power in the calculation as day 199. Some people have their favorites. I use both. If you don't quite understand moving averages, please go back to the section where I talk more about that in depth. And I go into a lot more detail in my not for free classes where I talk about technical analysis and how moving averages can be used. The next chart is a weekly chart, and I know there's 52 weeks in a year, but 50 period moving averages are quite popular. And since 50 is close to 52, I went ahead and plotted a 50 simple moving average on that chart. And then I'll look at a monthly chart going all the way back to 1980. And there are 12 months in each year. So I've plotted a 12 period simple moving average. So let's look at this first chart. There's nothing really special about this other than we show price. It's a log chart, so you can see the numbers over on the right-hand side are kind of scrunched up as we get higher and higher. We're not as concerned with the numbers. What we're looking at more is the price movement that we can see going back to 1980. We also see the red line here. That's the 200 simple moving average. A very basic way to interpret this is when prices are above the red line, that's positive. If we look way over on the right-hand side, you can see price is currently above the red line. And then we can look at the red line itself. The red line is also going up. So we have some positive clues that we can get from this chart. Price is above the moving average, and the moving average is also going up. Let's look at this on a weekly basis. We see pretty much the same thing. Each one of these plots is 1 week, but we can see on the right-hand side that price is above the moving average and the moving average is moving up. Then we can go back further and look at a monthly chart where we see almost the same thing. Price is above the moving average and the moving average is going higher. So we have 3 confirmations right here, right now, at the end of October 2021 that say that the trend is positive. Now, there are some things to be concerned about, and there's always things to be concerned about. I'm just focusing on this chart right here, right now. One thing that can be a little bit concerning is when we see price getting far away from that red line, the moving average tends to act like a magnet, or price tends to act like a rubber band. If it gets too far away from that line, it has a tendency to come back, which would mean in the opposite direction. So once we get too far away from the moving average, that is quite often prime time for some kind of a pullback in prices. Just to give you another look, here's the daily, weekly, and monthly charts. They're kind of small and it's a little hard to see, but really, even though we're going back 41 years on this chart, these charts almost look identical. Now let's look at some arithmetic scale charts. This is a daily chart, also showing a 200 period moving average. If you look way over on the right-hand side, you'll notice the numbers aren't all scrunched up with each other. But if you look at prices going back to 1980, they're not as pronounced. The movements don't look as big. If you look at 1987, that's just a little blip down. That was a huge stock market crash. But looking at this chart, we see that price is above the moving average and the moving average is moving up. Now let's go to the weekly chart. We notice the same thing. Price is moving up, it's above the moving average, and the moving average itself is moving higher. And if we look at the monthly chart, we notice the same thing. Price is above the moving average and the moving average is moving higher. So we've now had 6 confirmations of an uptrend. If there is one thing that's a concern, it's that we're getting far away from the moving average. We look at other tools to determine that. And just to show you again, we have the daily, weekly, and monthly chart all in a row here, and they look pretty much identical to each other. This is where we can get some insight, is on this next chart. On the top, you have the monthly arithmetic scale, and then below you have the monthly log scale. Same information, they're both showing the S&P 500, but we get a little different view. It's telling us the same thing, where price is above the moving average both on the arithmetic and log scale charts, but you can see where price moves a little bit differently and it looks a little bit different. And sometimes we can look at this to gain some insight that we would not have by just looking at one version of the chart. The next area I want to talk about are a thing called market phases. And just like we have 4 seasons every year, winter, spring, summer, fall, the market also goes through different phases. There's a time when it goes up, there's a time when it goes down, there's a time when it goes sideways. We just need to figure out what is actually happening at any given time. When the market is going up, we call that a bull market. The long-term trend of the S&P 500, or if you're investing in a stock, we are in a bull market overall. There's a saying on Wall Street that says, a rising tide lifts all boats. The tide could be the S&P 500. Well, if the S&P is going up, there's a good possibility if you have a high beta stock, which means it moves hand in hand with the market, your stock is probably going up as well. And the inverse of that is also true. What we're seeing on the charts is that since 2009, we have been in a bull market. So this is going on 12 years. That's pretty long for a bull market. What's going to happen in the future? We'll have to analyze things day in and day out just to see where they're headed. But this bull market has been pretty strong, especially since 2016. From time to time, you may hear about a thing called a correction. What is a correction? Well, when the S&P 500 or your stock or the Dow or the NASDAQ 100, when they hit a high, either an all-time high or a significant high, and then they fall back 10% or less, that is considered to be a correction. Once prices fall anywhere from 1 to 10%, find some support and then bounce up out of that, that is just called a correction. It can be really hard to tell at that time, because the trend can change from being up to down where it just starts out as a correction. Then all of a sudden it turns into a bear market, which is what I'll talk about next. But there is a lot of information that's given off by the markets to help us determine, is this a correction or are we actually starting to see a change in trend? Just as an example, as I record this, we're hitting all-time highs with the S&P 500, but a week or so ago, we were in a decline. And a lot of the doom and gloomers out there, they were predicting the end of the bull market and everything's going to crash and we're going down and the highs have been put in for this particular period of time. Well, a lot of these doom and gloomers have been saying that for the last 20 years. Anytime they see some kind of a blip downward, first of all, they call it a crash and not a correction. And they think that, oh, here we go. This is it. This is the big one. Well, I was looking at other information at the same time and I wasn't quite as concerned. I saw, yes, some negative signs, but I saw some real positive signs too. If those positive signs had started to turn over and become negative, then I would have become more concerned. They never turned negative. So as we come up out of this correction and we're back to setting all-time highs, we can have more confidence that we're in a good solid uptrend. Just as another example, in early 2020, the markets actually fell 20%. Now 20% or more, that is a bear market. That's what we get for the definition. When the trend changes from bull going up to bear going down, once you've surpassed that 20% mark, you are now in a defined downtrend. The only problem is we had a V shape out of that plus 20% decline, and we bounced up really strong, and we've been back to hitting all-time highs. So let's look at a bear market. This is when the long-term trend of the S&P 500 or any index is down. And this usually starts when an index, such as the S&P 500, falls from an all-time high or some kind of a significant top, 20% or more. That's the definition of a bear market. And you'll see all of our moving averages and our other indicators start to switch and become more negative during that time. Just because we see a few down days, even if we see an 8, 9, or 10% correction after having a strong bull market, that doesn't necessarily mean the trend is changing. We watch out and we look for other clues to see if things are changing, but it doesn't mean that the tops are in and that the end of the world is coming soon. We may bounce up out of that, but there are other times when we don't bounce up out of that and we continue to fall further and further into a bear market. As of October 2021, which is when I'm recording this, the markets have recovered after having the COVID plunge, and they've resumed the bull market. Even though we met the definition for a bear market, that happened so quick. We went down, we went well over 20%. We bounced up out of that and have seen some really strong gains since then. Now, you can give lots of reasons as to why. There's a lot of manipulation going on. There's tremendous stimulus being thrown into the markets. There's a lot of policies that are being passed in Washington, D.C. that have really helped the stock market regain its strength. We look at those things, we make note of those things, and we study those things. But when it comes to when we make decisions, we ultimately have to look at what is price doing. We don't bring our own biases or our own opinions to the market. We just look at the chart in front of us and say, okay, this is what's actually happening. And we have to go with that, even if you disagree with it, even if it doesn't feel like the right thing to do. We have to look at what's really happening. And that is part of the mental analysis that we have to work through. I often say this, the investments and trades that will show you the most success, they'll feel like the exact wrong thing to do at the time you get into them. Only time will prove them to be successful. If you wait until everything feels right to get in or get out, you're going to be way behind the curve and you're going to lose pretty much every time. The idea is to go with what you see, act upon that, even though your emotions might be telling you different, and just say, okay, this is my plan. I have my safety measures in place, so if I am wrong, I'll just get out and go on to the next one. If I'm right, man, I'm going to look like I really know what I'm doing. Everybody is a genius in hindsight, but we don't invest in hindsight. We invest in foresight. What is happening right now, and what do we think will happen going forward? And then we have periods of time, which can be anywhere from 60 to 80% of the time, where the markets really don't go anywhere. They might go up a little bit, down a little bit, but they're really choppy. It can even look like an uptrend on a chart, but really our other indicators suggest that we're not really in a trending market. And this can happen within longer-term bull or bear markets. Usually it happens more in bull markets. Prices tend to fall a lot faster than they tend to rise. The example that I give is, let's say you work at Boeing. I'm from the Seattle area, so I talk about Boeing a lot. You might spend 50 years of your life buying Boeing stock over a period of time and then sell it all in one day. Well, there's other investors that do the same thing. They may take a long period of time to buy and then sell it all at once. And when you see lots of selling going on, that makes prices go down a lot faster than they go up. But when we're in these sideways markets, it's very common for the S&P 500 or the Dow or the NASDAQ 100 or stocks to remain trendless, especially when you're looking at shorter time frames. Shorter time frames in this definition are days to weeks. There are strategies that we can use to take advantage of that. And what I try to do in my program called the SPX Investing Program, I try to help my students to identify what is the S&P 500 trending right now. Is it in an uptrend or a downtrend? And I look at all the different time frames and then help you to identify what strategies are best to implement. And we have strategies for all of the different environments, up, down, and sideways, and you can make really good returns in all of those environments. The next part of market phases that I want to talk about just gives you a graphical representation of how this looks. I didn't draw this. I'm not very good at drawing. I found this online somewhere. I hope I'm not violating any copyright laws here. Starting over on the left-hand side, we think, okay, I'm going to invest in the stock market. I read some books. I went to a webinar. I met some people that have had some success. I'm really optimistic about what's happening. The market's been doing pretty well lately. So you start off with this idea that you have enthusiasm about the market. The market's been going up. People get excited about that. The enthusiasm grows to the point where prices are going up and up and up and up. And we're seeing that a lot in cryptocurrencies right now. Prices are really shooting up after really taking a dive, and people are just afraid of getting left behind. And so they want to get in. They're exhilarated about things. When you get to the point of exhilaration, that's where people are just throwing money in the market and they're really using no logic behind it and very little knowledge and absolutely no experience in doing this. They're just seeing an opportunity to buy low and sell high. Well, that's when bubbles form. And you get to the point where this green line gets all the way to the top and you don't have anybody else to buy. All the buyers have bought. That's when the bull market ends. You don't really know it at that time. And a lot of people think, oh, we just hit a top and we're starting to go down. They predict that the bull market is over only to be wrong. And some people have been wrong 5, 10, 15, 20 years now. And I do read a lot of the doom and gloomer blogs. I subscribe to a few newsletters. I use them as contrary indicators. If they say we're going up, I'm pretty convinced we're going down. If they say we're going down, I'm pretty convinced we're going up because they could not even work harder to be wrong at this. But they're right just enough to justify what they're doing. Well, when prices do finally start to roll over, and we're not really sure it's happening at that time, you see prices start to decline, and you're starting to feel a little bit uneasy about things. Some of your profits have been bitten into. If you got in at the top, you're already starting to see a loss. So then you wonder, what are you going to do? It's like, okay, it can't go any lower. It can't go lower. Well, it does go lower. And then you get to the point where you're in denial. Oh, baby, this was such a good investment. No, it's not going to go any lower than this. It'll come back. As prices continue to fall, your denial that it can't go any lower suddenly turns into pessimism because they are going lower. And now you're seeing a real change in attitude. Most of your profits are probably gone by this point. If you got in at the top, you're seeing heavy losses. You kept thinking that it's going to come back. It's going to come back. Well, it didn't come back. And then you get to the point where, especially if you use borrowed money or margin to get into some of these, now you get to the point where you're seeing such heavy losses, you're starting to panic. And when more and more market participants start to panic, eventually you get to the point which we call capitulation. Another word that we use for that is a market crash. That's when people say, forget it, I'm done, get me out. I don't care what the price is at this point. I'm seeing a lot of losses. In fact, I owe more than I invested now because I use borrowed money to do this. And I'm sick of this. I'm tired of watching prices go down day after day after day. Forget about it. Those people that are in short positions, that's when they start to cover or they start to buy back the positions that they sold at the very top. And they're making some really good profits at this point. But those people that are long, they're losing their shirts. This is the point when we want to look at going long or buying. It's not going to feel like the right thing to do. The news is going to tell us, oh my gosh, it's the end of the world. Everybody's going to talk about how much they've lost in the stock market. Nobody's going to want anything to do with it anymore. That's when we go in and start looking for opportunities that we would not have bought at the very top. We're going against the herd at that point. And at some point, the bear market is over, and all of a sudden, we start to see prices rebound. Well, at first, we're not really sure. Is this just a dead cat bounce? Because you can even get a dead cat to bounce if you throw it down hard enough. So it might give off some false signals. But if you trade according to your plan and you're using mental analysis, you're going, okay, maybe I'm willing to take a little bit of a risk here. Prices continue to go a little higher. Now you start to see hope because you're seeing some profits in your initial positions. And so you add to those positions and that hope gets greater and greater. And now you get to the point where you're seeing some relief. We've bounced up out of that low, and people are now starting to call it a low. All the geniuses that didn't call it a low at that time, they can look back too and say, yeah, we come up out of the December lows or the February lows. They weren't saying that at that time. They just use hindsight to determine that for them. Well, what we try to do is take advantage of that way before everybody else does. And now you get to the point where you're seeing some relief because you're seeing some profits, and then you get all the way back up to being optimistic about the market again. And that's the whole cycle. The idea is to do the opposite of what everybody else is doing. Now, there is a time when buying like everybody else is doing is the right thing, and the inverse of that is also true. But we're talking about at major turning points. If everybody's screaming sell, we want to look to buy. If everybody's screaming buy, we want to look to sell. We use a lot of these as contrary indicators, and I have lots of indicators that I look at every day. Some of them I can't show you because of copyright laws. Just so you're familiar with this, we do have a lot of different stock market terms that we need to come up with. And there's acronyms and there's cliches and there's all kinds of things. But you might hear the term secular bull market. I'm not really concerned with this so much. Somebody came up with this idea of a cyclical bull market and a secular bull market. A secular one just means it goes on a lot longer, where a secular market is usually a shorter period of time. Since we're looking at the charts in front of us every day and we're making decisions that way, we don't really care if this has gone on for 1 year or 20 years. But a secular bull or bear market is categorized by either above or below stock market returns over a period of nearly a generation. Now, what's your definition of a generation? Is it 10 years, 20 years, 40 years, 70 years? Different people have different definitions of a generation. A lot of times in a family situation, we say my grandparents' generation, my parents' generation, my kids' generation, my grandkids' generation. Well, that can vary in the number of years. So there's a little bit of subjectivity coming along here when we're trying to make definitions of how long these periods are. Then we have a cyclical bull or bear market, and this usually lasts about the same amount of time as a business cycle. Just think of it. The big companies out there, and even small companies, when they're expanding, they have a lot of sales, they're bringing on new people, they're building new factories, they're coming out with new products. Well, eventually things get to the point where they're not making the sales that they were making before, so they start pulling back. They don't produce as much. When they don't produce as much, now they have to start letting people go. And now they have to start to cost cut and maybe try to pay off some debt that the company incurred because the sales are just not happening right now. Well, eventually you get to the point where things start to get good again. And this goes over and over and over, just like the 4 seasons every year. There are seasons in the business cycle, there are cyclical seasons, and there are secular seasons. For example, since hitting a bottom in March of 2009, equities, meaning stocks, have experienced a more than 12-year cyclical bull market. Now, some people might say, well, that's a generation. We should call this a secular bull market. I don't really care. I'm just looking at what's happening right now based on the bigger picture and bringing it down to the smaller picture. What you want to call it is fine. Since this has lasted for so long, we could classify what has been going on since 2009 as a secular bull market. But think about this. We've had some pretty big setbacks during this bull market. 2011 into 2012, ran into some trouble in 2013, 14, and then we had 2016. You had Brexit and the whole election that happened that year. Then in 2020, we had the whole COVID lockdown. We had the plunge, followed by the bounce coming up out of that. So yeah, we're in a bull market. It doesn't mean that everything is smooth and everything's going to just go straight up. There's going to be some severe bumps along the way. But overall, using longer term moving averages, this helps to cut out a lot of that noise and give us more insight as to the condition of what's actually happening. We're not using emotions, we're using logic. The question that we should be asking ourselves is, was 2009 the beginning of a new secular trend? I really don't care, but this is what a lot of other people are asking. Or is this merely a cyclical divergence within a secular bear market? There are the doom and gloomers out there who think that the world is coming to an end as far as the stock market is concerned, and that what we've been seeing for the last 12 years is just a dead cat bounce out of a longer term bear market. You can take a lot of these charts and twist them in different ways and come up with whatever you want. There's a lot of other analysis tools that I talk about in some of my other classes and videos that people use and rely on that I think are pure garbage. But yet they use this to form their conclusions, and sometimes their conclusions are different than our conclusions, and we want it that way. We don't want everybody to be buyers at the same time and everybody to be sellers at the same time. We'd never get in and we'd never get out. Remember, when you get into the market, and let's say you're hoping to buy low and sell high, well, you're buying that from somebody who thinks we've already hit the high and prices are going to go lower. The person on the other end of that transaction is thinking the opposite of what you're thinking. So keep that in mind as you're making decisions. Yes, we want to look at what other players are doing. We want to look at it in a mature, unemotional, logical manner to reach our conclusions. So that concludes Module 5, Section 1, and I will pick up again in Section 2.